Good afternoon, and I will be presenting a video on financial management. In fact, it's the introduction to financial management, what financial management consists of. So, financial management is actually a discipline which is the backbone uh, of any professional professional course like BBA, BCom honors, etc. So first I will start with introduction, which is the definition of financial management. Financial management is that managerial activity which is concerned with planning and controlling of the firm's financial resources. It was the branch of economics till 1890, and as a separate discipline, it is of recent origin. So, scope of finance. Firms create manufacturing capacities to produce goods and services. They they sell their goods and services to earn profit. They raise funds to acquire manufacturing and other facilities. The three most important activities of a business firm are production, marketing, and finance. A firm secures whatever capital it needs and employs it in finance activity in activities which generate returns on invested capital, which is production and marketing activity. A firm requires real assets to carry on its business. Tangible real assets are physical assets like that include plant, machinery, office, factory, furniture, and buildings. While intangible real assets include technical know-how, technological collaborations, patents, and copyright. Financial assets, also called securities, are financial instruments such as bonds and shares or debentures. So this is a general introduction to financial management, and now we will delve into what are these securities. Firms issue securities to investors in the primary capital markets. Markets to raise necessary funds. It requires funds for production and marketing, so it issues securities to investors in the primary capital market. The securities issued by firms are traded in the secondary capital market, which are also known as stock exchanges. Financial assets are also include lease, obligations, and borrowing from banks and other financial institutions and other sources. In a lease, the lessee obtains the rights to use the lessor's asset for an agreed amount agreed amount of rental over the period of lease. Funds applied to assets by the funds are called capital expenditure or investment decisions. The fund expects to receive return on the capital invested and distribute return or profit, and might distribute return or profit as dividends to investors. As distribution dividend is not an obligation for a firm, it can retain its earning also for investing in future profitable business ventures. Equity. Now we will distinguish between what is equity and borrowed funds. There are two types of funds that a firm can raise: equity funds, simply called equity, and borrowed funds called debt. A firm sells shares to acquire equity funds. Buyers of shares are called stockholders or shareholders, and they are the legal owners of the firm whose shares they hold. The return to shareholder consists of dividend or capital gains. Shareholders make capital gains or loss by selling their shares in the secondary capital market. Shareholders can be of two types: ordinary and preference. Preference shareholders receive dividend at a fixed rate. They have a priority over ordinary shareholders. Now coming to dividends paid by, now what are dividends, how are they taxed and all. So dividends paid by a company are not deductible expenses for calculating corporate income taxes. They are paid out of profits after corporate taxes. After a company pays taxes to the government, then the dividends are distributed. As per the current laws in India, companies are not required to pay dividend distribution tax. Now this onus rests on the shareholders to pay taxes on their dividends. Okay, so this is this started from April 1, 2020. The tax burden now falls on investor who receives the dividend. So in India there is a system of double taxation is followed. Now TDS deduction. The companies paying the dividend must deduct tax deducted at source. As of April 1, 2025, a 10% TDS is deducted if the dividend paid to the shareholder exceeds rupees 10,000 in a financial year. If you receive dividend which exceeds 10,000 from any company uh, which exceeds 10,000 in a financial year, then the company will deduce tax deducted at source. And if you do not fall under income tax bracket, then you can claim it by filing two forms 15H for persons below 65 years of age and 15G for persons above 65 years of age. A company can also obtain equity funds by retaining earnings available for shareholders. Retained earning are the portion of company's cumulative net profit that is kept and not distributed as dividends to shareholders. If a company distributes all its earnings to shareholders, then it can reacquire new capital from the same source, existing shareholders, by issuing new shares called right shares. Also, public issue of shares is also possible to maybe made to attract new as well as existing shareholders to contribute equity capital. Another important source of capital is creditors or lenders. Lenders are not the owners of the company. They make money available to the firm as loan or debt and retain title to the funds lent. But natural, if we acquire loan from any bank for maybe car loan or house loan, so the bank has the right to claim the loan. Okay, so it retains title to the funds lent, and it charges interest on that. Loans are generally furnished for a specified period at a fixed rate of interest. For lenders, the return on loans or debt come in the form of interest paid by the firm. Interest is cost of debt to the fund, but natural it is cost of debt to the fund. That you acquire the debt, and what is the cost that you are paying apart from the debt? That is the interest. Payment of interest is a legal obligation. The amount of interest paid by a firm is a deductible expense from corporate income taxes. Thus, interest provides a tax shield to the firm. The interest you pay, that it provides a tax shield to the firm. The interest tax shield is available to a firm. And as a bonus, I'm telling you that generally deductible under section 36(1)(3) and section 37 of Income Tax Act. This corporate income tax is deductible under section 36(1)(3) and section 37 of Income Tax Act. So sources of funds borrowing are what? Banks, financial institutions, public, and issuing bonds or debentures. Now we have come to two new terms, that are bonds and debentures. A bond or a debenture is a certificate acknowledging the amount of money lent by bondholders to the company. It is generally of a very long period of time, from 10 years to 15 years to 20 years also. So it is a very profitable debt source, since you have to pay it after 10 to 15 years. It states the amount, the rate of interest, and the maturity of the bond or debenture. Since bond or debenture is a financial instrument, it can be traded in secondary capital market. Also, when you acquire the bond or debenture, you can trade it in secondary capital market when you are a bond holder or a debenture holder, secondary capital market, and you can earn money from that. You can earn profit from that, or maybe you can even incur losses. Okay. The functions of raising funds. So we have come, finally I am winding it up by telling what are the finance functions. We will continue the next day with our class, um, which will delve deep into the introduction of financial management. Now I will come to finance functions. The functions of raising funds, investing them in assets, and distributing returns earned from assets to shareholders are respectively known as. But by raising funds is financing decision, investing them in assets is investment decision, and distributing the assets to shareholders is dividend decision. And while raising funds, distributing, investing and distributing returns, what we do, we are continuously uh, making cash inflows and outflows while performing these functions. And what is it called? It is called liquidity decision. So, in a nutshell, the finance function includes long-term asset mix or investment decision, capital mix or financing decision, profit mix or dividend decision, and short-term asset mix or liquidity decision. Means what? Finally, I am summing it up. Long-term asset mix or investment decision or capital expenditure decision, capital mix or financing decision, profit allocation or dividend decision, and short-term asset mix or liquidity decision. Hope this helps, and thank you for listening so patiently.